Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way.
Yeah, and there is definitely a lot to break down today.
There really is. Because look, if we just look at the data right now, the Strait of Hormuz is currently blocked.
Right.
And Brent crude oil just spiked. I mean, it went over $126 a barrel. I think the recent analysis had it hitting exactly $126.41.
Which is just a massive, massive spike.
It's huge. We are basically staring down the barrel of a major escalating geopolitical conflict involving Iran. And yet, if you look at your screen right now, the Nasdaq just shot up over 15% in a single month.
Yeah.
The S&P 500 jumped over 10%.
It's wild.
It's May 1st, 2026. We're navigating this entire financial landscape under the Trump administration. And, if your portfolio is giving you severe whiplash right now, you definitely aren't alone.
Oh, absolutely not. I mean, it creates this massive cognitive dissonance for everyday investors.
Right, because the disconnect between the terrifying reality on the news and the absolute euphoria in the stock market is just staggering.
It really is. You look at the raw macroeconomic data, and it paints a picture of absolute chaos. Like, supply chains are choking, energy prices are surging.
Yeah.
And traditionally, those are the exact conditions that drain liquidity from the system. It causes institutional investors to panic and just liquidate their position.
But they aren't liquidating.
No, they're buying.
They are buying aggressively, which kind of brings us to the core mission of this deep dive today. We really need to dissect why simply knowing the facts, like having the perfect data, is no longer enough to survive in this market.
Yeah, having the right information doesn't automatically mean you make the right moves anymore.
Exactly. So we're going to break down the critical difference between what we call knowledge-based investing and wisdom-based investing. Because honestly, the old playbook of treating the market like a simple math equation, it's actively destroying wealth right now.
It really is. And let's define that knowledge-based approach first, because it's sort of the default operating system for almost everyone who, takes a basic economics 101 class in college.
Right. It's what we're all taught to do.
Exactly. Knowledge-based investing relies on establishing a logical chain of cause and effect. So you gather the facts, you map out the logical conclusion, and then you allocate your money based on that conclusion.
It's the classic if A, then B model.
Spot on.
Like if I'm looking at the data right now, a purely logical investor sees oil at $126. They know high oil means elevated gas prices at the pump, higher shipping costs, and that directly feeds into high inflation. High inflation means the Federal Reserve is forced to hold interest rates higher for longer. Expensive borrowing crushes corporate profit margins. So therefore, stocks should be tanking.
That is the perfect, completely logical, knowledge-based conclusion.
Right. It makes perfect sense.
And that logic is precisely what has left a lot of very smart people just sitting on the sidelines, holding cash, and completely missing a historic 15% rally.
Wow. So being right actually costs them money.
Exactly. The fundamental flaw in knowledge-based investing today is, it's the assumption that the market cares about all data points equally.
Oh, interesting.
Yeah, the reality is that the market's priorities are ruthlessly selective.
Right. So it's not that the market is blind to the inflation or the war. It's just prioritizing other things like capital flows and tech liquidity over all that geopolitical noise.
Yeah, exactly.
It reminds me of, it's like checking a highly advanced weather app on your phone, right?
Yeah.
And the app guarantees there is a 100% chance of a Category 5 hurricane. So you board up your house, you hide in the basement, but then you look out the window and everyone is outside having a sunny beach party.
That is a perfect analogy.
Yeah. Like if the data is completely accurate, which it is, inflation is up, why is the market just ignoring the hurricane?
Well, let's dig into the mechanics of how the data itself gets interpreted. Because, like you said, the knowledge isn't wrong. Inflation is rising. But the way institutions look at that inflation changes everything.
Okay, explain that. How are they looking at it differently than the average guy at the grocery store?
That's where the concept of the lens comes in. Knowledge relies on easily measurable facts. But financial markets, they operate on the interpretation of those facts.
The interpretation, okay.
Right, so let's look at inflation. If you measure what we call headline inflation, which includes highly volatile components like food and energy, it looks completely apocalyptic right now because of that oil spike.
Right, because gas and groceries are the things regular Americans notice every single day.
It's exactly. But the Federal Reserve doesn't govern its monetary policy purely on those headline numbers.
Hmm.
They actually prefer metrics like trimmed mean inflation.
Trimmed mean inflation. Okay, for our listeners who might not track the absolute minutia of Fed policy, what exactly is trimmed mean?
Sure, so trimmed mean inflation takes the entire basket of goods and services that Americans buy, and it simply chops off the extreme outliers on both ends.
Oh, like when a teacher throws out the highest and lowest grades in a class to find the real average.
Yes, exactly like that. It ignores the things that spike the most and the things that drop the most,
Yep.
just to find the true underlying center of gravity for everyday prices.
Okay, so if oil is spiking crazy high because of a specific isolated bottleneck over in the Strait of Hormuz,
Right.
but the broader cost of, say, services or used cars or apparel is actually slowly cooling down,
Yeah,
the trimmed mean inflation rate might actually look totally fine to the Fed.
exactly. And if it looks fine to them, the Fed has the justification they need to avoid a panic rate hike.
What?
So knowing the raw fact that oil is at $126 is completely useless if you don't realize that the central bank is currently viewing the whole economy through the lens of that trimmed mean metric.
That is wild. So if perfect data doesn't equal perfect predictions, how is an everyday American investor supposed to actually survive this? I mean, we can't just abandon logic and throw darts at random tech stocks, right?
No, definitely not. This is where we have to transition to what recent analysis calls a wisdom-based framework.
Wisdom based. Okay, how is that different?
Wisdom doesn't mean ignoring the data. It means structurally accepting that your knowledge is incomplete.
Interesting.
Yeah, you stop trying to predict the future perfectly, and instead you build a portfolio designed to survive being wrong. You basically withhold absolute judgment.
Structurally responding rather than predicting.
Exactly.
Let's make that concrete for the listener because, if I'm looking at the terrifying situation in the Middle East right now, my instinct isn't a structural response. My instinct is to build a bunker.
Right, sell everything.
Yeah, I want to sell everything, go to cash, and just hide. It's like going scuba diving, right? You want to see the coral reef and experience the thrill of the ocean, but you don't jump in without a scuba tank.
I love that. Yes.
How do everyday investors strap on the scuba tank in a market that feels both completely terrifying and overly euphoric at the same time?
Well, look at what the smartest money on Wall Street is doing.
Huh.
Because recent earnings data shows they are doing the exact opposite of hiding in bunker.
What are they
A
doing?
perfect example of this is the Intercontinental Exchange, or IC.
I see, okay.
Yeah, they operate the New York Stock Exchange and several massive global trading and clearing platforms. They recently reported their first quarter profits for 2026, and the numbers were just staggering.
But it's the mechanics of how they made that money that I find so revealing from the data.
Right.
Because their profits weren't driven by stocks just going up in a straight line. They were driven heavily by increased volatility and frantic energy trading.
Yeah.
It's basically like running a casino during a gold rush. Like the traders out there, they're the ones taking the massive existential risks, right? They're betting it all on red or black based on the latest news out of Iran.
Yeah.
But ICE is the house.
That is the exact mechanism at play. They don't take a directional bet on whether oil is going to $200 or crashing down to $40. They simply facilitate the chaos.
They just take a tiny fraction of a cent on every single frantic bet placed. So to ICE, volatility just means more people are pulling the lever on the slot machine.
Precisely. The volume of fear translates directly into a volume of fees,
Man, that's smart.
which proves that institutional capital isn't paralyzed by uncertainty. They actively trade with the fear. They use complex derivatives, insurance, and hedges to capture the friction itself.
So for the everyday investor, how does the wisdom approach mirror that? Because I can't exactly open my own stock exchange.
Right, no. But the wisdom approach means you don't liquidate your life savings and sit in cash waiting for the sky to fall. Because, honestly, inflation will eat that cash alive.
Right, cash loses value every day.
Exactly. But you also don't go all in on margin and take crazy risks.
So you adjust your position sizes.
Yes, you might hold some short-term treasury bills that pay a nice guaranteed yield while you wait for the dust to settle, but you keep your core investments actively participating in the market's upward momentum. You just lower the cost of being wrong.
Lower the cost of being wrong. I like that.
Yeah.
Let's actually apply this wisdom framework directly to the two massive forces pulling the market right now. Let's start with the negative uncertainty, the reality of the Iran war.
Okay, yeah. Let's look at the inflation swap markets for this.
And just real quick, inflation swaps, these are essentially tools that massive institutional players use to hedge against or bet on where inflation is heading over various time frames,
Not
right?
exactly. And recent analysis shows that one-year inflation swaps just hit their highest level since the initial shock of the Ukraine conflict back in 2022.
Wow.
Yeah. Wall Street is genuinely pricing in permanent, sticky inflation.
Now, normally, war and permanent inflation mean you should just dump risky assets. Isn't the wisest move just to run away from the stock market entirely?
You'd think so, but no.
Mm-hmm.
A wisdom-based approach recognizes that geopolitical conflicts create a violent structural gap between winners and losers. The danger isn't universal, it's very specific.
Okay, so the losers are fairly obvious, right? If you are holding long-term, unprofitable growth stocks that desperately need 0% interest rates just to fund their operations, you are going to get crushed.
Oh, absolutely.
And if you are investing heavily in countries that have to import 100% of their energy, their profit margins are just evaporating overnight with oil this high.
Right. But the winners in this scenario are fascinating. Energy traders and defense companies obviously boom during these periods. But let's look specifically at the European oil majors based on the data.
Okay.
In the first quarter of 2026, their earnings improved significantly.
And the crucial detail here is how those earnings improved, because they didn't suddenly discover massive new oil fields, right?
No.
And they weren't just pumping more crude out of the ground. Their earnings skyrocketed because of arbitrage.
Yes. Let's break down that mechanism. Because understanding the arbitrage is key to understanding how volatility actually generates cash.
Right, because these oil majors, they actually own the physical infrastructure.
Yep.
They own the massive storage tanks, the pipelines, the huge shipping fleets. So they aren't at the mercy of the daily paper markets like some guy day trading in his basement.
Exactly. When panic hits and prices swing wildly in a single week, they can buy cheap paper contracts on a Monday when market sentiment dips.
Right.
Then they actually take physical delivery and store that oil in their tanks. And then they turn around and sell it at a massive panic-driven premium on Thursday when a terrifying new headline hits the news.
They are literally monetizing the chaos.
They are. They're absorbing the market's fear and converting it into a risk-free profit margin.
So the wisdom for a regular investor here is really about managing exposure. You acknowledge that the unknown has grown larger.
Right.
So you lower your leverage, you make sure you have some capital deployed in short duration bonds, and you hold companies like these energy infrastructure giants or defense contractors that act as a sort of shock absorber for your portfolio.
That's a great way to put it. A shock absorber. If the conflict escalates, the rest of your portfolio might bleed, but those specific assets surge, and that provides the liquidity you need to survive the shock.
You aren't trying to predict the exact date a peace treaty gets signed. You are just designing a portfolio that doesn't blow up if the war lasts another 5 years.
Exactly.
Okay, so that covers the downside, the negative stuff, but we really have to pivot to the upside because the positive uncertainty in this market is just as extreme.
Oh, yeah.
I mean, we cannot ignore a 15% surge in the NASDAQ in 1 month. How does a wise investor handle the euphoric, FOMO-driven reality of the AI boom? Because the fear of missing out is real right now.
It is very real. And the scale of the capital expenditure cycle we are witnessing is just historic. In 2026 alone, data shows that Alphabet, Microsoft, Meta, and Amazon are projected to spend a combined $600 billion on AI infrastructure.
600 billion. That number is almost difficult to comprehend.
It's massive.
But according to some recent analysis from Goldman Sachs, there's a huge catch here. They estimate that roughly 75% of the S&P 500's current valuation is based entirely on something called terminal value.
Yeah, terminal value. That is a critical structural concept for our listeners to grasp.
Let's define it clearly for them. Terminal value essentially means that investors are paying incredibly high premium prices for stocks today, not because of the actual cash those companies are making this quarter,
Right.
but based on a mathematical assumption of massive world-changing profits a full decade from now. It's like paying $100 for a neighborhood lemonade stand today, just because you assume it'll make $10 a year in 2036.
That's exactly it. It requires a profound amount of faith. You are pricing in a flawless execution of unproven business models over a 10-year horizon.
Which brings up the obvious parallel. If the data tells us this is a bubble driven by FOMO, And valuations are entirely detached from current cash flow.
Yeah.
I mean, that is the exact mechanical setup of the dot-com bubble back in the year 2000, and we all know how that ended.
Painfully.
Very painfully. So wouldn't the logical, knowledge-based conclusion be to just stay out of AI entirely until the dust settles and the bubble pops?
Logically, yes.
Yeah.
But practically, staying out entirely is a structural failure of its own.
Really? Why?
Because if you sit on the sidelines waiting for a crash, you miss out on the very real compounding returns happening right now. I mean, a 15% gain in a month is life-changing capital.
True.
The wisdom approach isn't to just abstain completely. It is selective participation based on the actual mechanics of the technology.
Selective participation, because even within the AI sector, there's a really violent separation occurring right now, right? You can't just buy anything with AI in the name anymore. If you bought into random software startups last month just because they had AI in their pitch deck, you're probably bleeding cash right now. The market has realized a terrifying vulnerability. Software is becoming a depreciating asset.
That is a brilliant point. I mean, why would an enterprise client pay a premium for a fancy new AI software subscription today when they are terrified that OpenAI or Anthropic will simply release a smarter, faster model that makes that exact software completely obsolete for free tomorrow?
Right. The moat around software companies is just evaporating.
It's gone.
So who is actually capturing that $600 billion in spending? It's not the unproven software startups relying on 10-year terminal value. It's the companies providing the physical bottlenecks.
Yes.
The picks and shovels of the AI gold rush.
The semiconductor manufacturers obviously are at the forefront of this.
Naturally.
But it extends much deeper into the physical world, which a lot of people miss. Data center operators.
Yeah.
Companies manufacturing advanced liquid cooling systems for these massive server racks.
Because they get so hot.
Exactly. And perhaps most critically, the power generation and grid infrastructure companies.
Because AI doesn't run on magic, right? It runs on electricity. Massive, unprecedented amounts of electricity.
Tons of it.
So the companies that own the transformers, the copper wiring, the nuclear power facilities, they are generating massive, highly visible cash flows today.
Right now.
Yeah. They don't need a theoretical terminal value a decade from now to justify their stock price, because Amazon and Microsoft are literally handing them billions of dollars in real cash right now just to keep the servers turned on.
Exactly. This is what we mean by selective participation. You stay invested in the companies with visible current cash flows.
Right.
You avoid betting blindly on unproven software dreams.
You keep your scuba tank strapped on, but you don't refuse to swim in the ocean.
Right.
It's about anchoring your portfolio to reality while the rest of the market floats on terminal value. Man, we've covered incredible ground today, from the Strait of Hormuz all the way to data center power grids. Let's kind of synthesize this deep dive for the listener.
Yeah, let's bring it all together.
The distinction between knowledge and wisdom really is the defining characteristic of a successful investor in 2026. Knowledge is looking at the macro data. It's knowing that Brent crude is at $126.
Right.
It's knowing that tech giants are dropping $600 billion on AI. Knowledge is just the raw material.
But wisdom is realizing that neither you nor I, nor the most sophisticated algorithms on Wall Street, can perfectly predict how those two massive forces, a geopolitical war and a technological boom, are going to actually collide in the real world.
Exactly. And because you cannot predict the exact outcome, you design an operating system that survives the collision.
Yes.
You hold short-term treasuries for liquidity. You own physical energy infrastructure that arbitrages the chaos. You selectively invest in the immediate physical bottlenecks of the AI revolution rather than the speculative software.
Yeah, and this framework is essential right now because of the broader era we are entering. According to the data, institutional investors are really beginning to price in a concept known as a permacrisis.
Permacrisis.
That sounds intense. It is. It defines a world where extreme geopolitical instability, supply chain fracturing, and massive technological disruption aren't just temporary, isolated shocks anymore.
They're the permanent baseline reality.
Exactly. We are transitioning from an era of predictable, synchronized global growth into an era of constant, low-grade friction.
Wow. And in a permacrisis, the ultimate winners are never the investors who try to perfectly predict tomorrow's news headlines.
Now you can't.
The winners are those who buy into resilience, companies with fortress balance sheets, strong current cash flows, and the pricing power to pass their elevated costs directly onto the consumer without losing demand.
Resilience becomes the ultimate premium asset.
It really does. Which leads me to a final sort of provocative thought I want to leave you with today. We spend so much time in finance trying to build safety nets, right?
Yeah, always looking for a safe harbor.
Exactly. We look for traditional safe havens to protect our wealth from the danger out there. But if we are truly living in an era of permacrisis, if extreme volatility, sudden inflation spikes, and overnight technological obsolescence are just the normal operating conditions of the 21st century,
Right.
maybe the riskiest thing you can possibly do is try to hide in a traditional safe haven. I mean, if the entire ocean is churning with Category 5 hurricanes, sitting in a fragile little rowboat of cash and hoping the storm passes isn't going to save you.
Because the storm isn't passing.
Right. It's the new climate. Perhaps the true safe haven moving forward isn't hiding from the volatility. It's owning a small piece of the very machinery that captures the volatility.
Like the trading platforms monetizing the panic.
Exactly. Or the energy majors arbitraging the fear. Maybe the best way to survive the lightning storm is to own the power grid that harnesses the electricity. So take a look at your own portfolio this week. Are you hiding from the friction, or are you structurally designed to capture it?
That's the big question.
It sure is. Don't forget to subscribe and hit that like button.